You are 24 years old. You wake up, grab your phone, and open your banking app. The screen loads, and there it is, $2,145. That is your entire life savings. Then you open your email. The first message is a reminder that your student loan payment is due next week. The second is a notification that your rent is increasing by $150 next month. You look around your cramped apartment, listening to the sound of your upstairs neighbor walking heavily across the floor, and you feel a familiar weight settling on your chest. You want out. You want your own space. You want to buy a house in the United States. But when you look at the housing market, where the average home price is hovering around $400,000, and mortgage rates are higher than they've been in a decade, it feels like a cruel joke. How are you supposed to save tens of thousands of dollars for a down payment when you can barely keep up with rent, groceries, and debt? It feels like you are drowning in a system designed to keep you renting forever. If this sounds like your life, you are not alone. Millions of young adults in the U.S. are standing exactly where you are right now. The gap between wages and housing costs has never been wider. But here is the truth that no one tells you. Buying a house is not reserved for the rich, the lucky, or those with trust funds. It is a mathematical equation. It is a game of strategy, patience, and specific financial maneuvers. Today, we are going to draw a complete, step-by-step roadmap. We are going to take you from having $2,000 in the bank and a mountain of debt to holding the keys to your own home in exactly 10 years. This isn't about skipping lattes or eating ramen noodles for a decade. This is a realistic, actionable, and proven strategy for the modern American economy. Grab a pen and paper, because this video is going to change your financial trajectory forever. Let's introduce our main character for this journey. We'll call him Alex. Alex is 24. He makes $50,000 a year working a standard corporate job. He has $2,000 in his checking account, $15,000 in student loans, and $3,000 in credit card debt. His rent is $1,400 a month. Right now, Alex feels completely overwhelmed. The biggest mistake Alex, and most people in his situation, makes is looking at the final goal. When Alex looks at a $400,000 house, his brain panics. It's too big of a number. So, he gives up before he even starts. To win this game, we have to break the 10-year journey into 3 distinct phases. Phase 1 is stopping the bleeding, years 1 to 3. Phase 2 is building the engine, years 4 to 7. And phase 3 is the execution, years 8 to 10. Let's start with phase 1, stopping the bleeding. Right now, Alex is losing money faster than he can save it. Why? Because of his credit card debt. Credit card debt is a financial emergency. If Alex is paying 24% interest on his $3,000 balance, the bank is actively stealing his future down payment. For the first year, Alex must forget about the house. He must forget about investing in the stock market. His only mission is to eliminate that high-interest debt. We are going to use a strategy called the debt avalanche. Alex will make minimum payments on his student loans, which have a lower interest rate, and throw every single extra dollar he has at the credit card. But where does that extra money come from? This brings us to the concept of income engineering. You cannot save your way to wealth if your income is too low. At $50,000 a year after taxes and rent, Jimmy has very little margin. He needs to increase the gap between what he earns and what he spends. He has 2 choices: drastically cut his living expenses or increase his income. Cutting expenses has a limit. You still need to eat and sleep somewhere. But increasing income has no ceiling. Jimmy decides to take on a side hustle. He starts driving for a rideshare app on weekends or doing freelance graphic design online. He commits to making just an extra $500 a month. That $500 doesn't go to dinners or new clothes. It goes straight to the credit card. Within 6 months, the credit card is at 0. The bleeding has stopped. Jimmy has just taken his first real step toward homeownership. Now, he has momentum, but he is still vulnerable. If his car breaks down tomorrow, he will have to use the credit card again, putting him right back where he started. So, for the next 6 months, that extra $500 a month goes into a high-yield savings account to build a starter emergency fund. By the end of year 1, Jimmy has 0 credit card debt and $5,000 in cash. He is finally breathing. Years 2 and 3 are about tackling the student loans and fixing the most important number in the American financial system, the credit score. Your credit score is your financial reputation. When you go to buy a house, the bank doesn't know you. They don't know if you are a good person. They only know your 3-digit score. A score of 620 might get you a mortgage, but it will come with a terrible interest rate that will cost you tens of thousands of dollars over 30 years. A score of 740 or higher unlocks the best rates and the lowest monthly payments. How does Jimmy build his credit score? It's surprisingly simple, but it requires discipline. First, he keeps his old credit card open, but he only uses it for one small recurring subscription like Netflix or Spotify. He sets it to auto-pay from his checking account every month. He never carries a balance. This builds a perfect history of on-time payments. Second, he keeps his credit utilization ratio below 10%. If his credit limit is $5,000, he never lets the balance go above $500 at any time during the month. While his credit score is quietly building in the background, Jimmy continues his side hustle and focuses on career growth. By year 3, he has negotiated a raise at his main job, bringing his salary to $60,000. He uses the extra income to aggressively pay down his student loans. By the end of year 3, Jimmy is 27 years old. His credit card debt is gone. His student loans are cut in half. His credit score has climbed from a mediocre 650 to a solid 720. And he has $10,000 in his emergency fund. He is no longer surviving, he is stabilizing. He has successfully completed phase 1. Now it's time to build the engine. Welcome to phase 2, building the engine. Jimmy is now 27, debt-free, or significantly reduced, and has a healthy emergency fund. His credit score is strong. He's no longer just stopping the bleeding. He's actively building the financial muscle needed to buy a house. This phase will cover years 4 to 7 of our 10-year plan. The primary goal of phase 2 is to accumulate a substantial down payment. For a $400,000 house, a 5% down payment is $20,000, and a 20% down payment is $80,000. While 20% is ideal to avoid private mortgage insurance, PMI, it's not always realistic for first-time buyers. We'll aim for a minimum of 5 to 10% and discuss strategies to get there. Jimmy's income is now $60,000 a year. After taxes, let's say he takes home around $4,000 a month. His rent is still $1,400. His student loan payments are manageable. He's still doing his side hustle, bringing in an extra $500. This means he has approximately $1,000 to $1,500 of disposable income each month. This is where the magic happens. Every single extra dollar now goes into a dedicated down payment savings account. This isn't his emergency fund. This is a separate, purpose-driven account. For money needed within 5 years, a high-yield savings account, HYSA, is usually the best option. It offers better interest rates than a traditional savings account, typically 4 to 5% APY, while keeping his money safe and accessible. Let's do some quick math. If Jimmy saves $1,000 a month for 4 years, years 4 to 7, that's $1,000 x 48 months equals $48,000. Add in the interest from the HYSA, and he could easily have over $50,000 saved. This is a significant chunk for a down payment, potentially allowing him to put down 10 to 12% on a $400,000 house. But saving isn't just about putting money aside, it's about making smart choices. Jimmy needs to continue his income engineering. Can he negotiate another raise? Can his side hustle grow into something more substantial? Perhaps he can use the skills from his side hustle to transition into a higher paying role at his main job or a new company. Every $100 extra he earns and saves each month translates to an additional $4,800 over 4 years. During this phase, Jimmy also needs to become a financial literacy expert. He needs to understand the different types of mortgages, FHA, VA, conventional. He needs to research first-time homebuyer programs in his state or city, which often offer down payment assistance or grants. He needs to understand property taxes, homeowners insurance, and closing costs, which can add another 2 to 5% to the purchase price. Knowledge is power, and in real estate, knowledge can save you tens of thousands of dollars. He also needs to start thinking about his housing preferences. What kind of house does he want? How many bedrooms? What neighborhood? What's his commute like? Does he want a fixer-upper or move-in ready? These questions will help him refine his target price range and make his goal more tangible. He can start attending open houses not to buy, but to learn, to understand what $400,000 actually buys in his desired area. This makes the dream feel real and keeps him motivated. Another critical aspect of Phase 2 is maintaining his excellent credit score. He continues to pay all bills on time, keeps his credit utilization low, and avoids opening new lines of credit unnecessarily. A strong credit score isn't just about getting approved, it's about getting the best interest rate. Even a quarter-point difference in interest can save thousands over the life of a 30-year mortgage. For example, on a $380,000 loan, a 0.25% lower interest rate saves him over $20,000 in interest payments over 30 years. That's real money. By the end of year 7, Jimmy is 31 years old. He has a down payment of $50,000 to $60,000. His credit score is likely in the excellent range, 760 plus. He understands the home buying process, and he knows exactly what kind of house he wants and where. He has built a powerful financial engine. Now it's time for the final push, the execution. We've reached Phase 3, the execution. Jimmy is 31 years old with a solid down payment, an excellent credit score, and a deep understanding of the housing market. He's no longer just dreaming. He's ready to make his dream a reality. This phase covers years 8 to 10, the final stretch to homeownership. The first step in this phase is to find a trusted real estate agent. This isn't just about finding someone to open doors for you. A good agent is your advocate, your negotiator, and your guide through the complex world of contracts and contingencies. Jimmy should interview several agents, looking for someone with experience in his target neighborhoods, strong communication skills, and a genuine understanding of his financial situation and goals. This agent will be crucial in navigating competitive markets and finding properties that fit his budget and needs. Next, Jimmy needs to get pre-approved for a mortgage. This is different from pre-qualification. Pre-approval means a lender has actually reviewed his financial documents, income, assets, credit, and committed to lending him a specific amount at a specific interest rate. This makes Jimmy a much stronger buyer in the eyes of sellers, especially in a hot market. He should shop around with multiple lenders to compare interest rates and closing costs, as even small differences can save him thousands over the life of the loan. With pre-approval in hand, Jimmy and his agent can begin the serious house hunt. This is where his earlier research into housing preferences pays off. He knows what he wants and he knows what he can afford. He needs to be patient but decisive. The right house might not appear immediately, but when it does, he needs to be ready to act quickly. His agent will help him analyze comparable sales, understand market trends, and make a competitive offer. Let's consider a scenario. Jimmy finds a house he loves for $420,000. He has $55,000 for a down payment. This means he can put down approximately 13%. While not the full 20%, it's a strong down payment that reduces his loan amount and keeps his monthly payments manageable. He'll likely still pay PMI, but with a good credit score and a solid down payment, it will be less burdensome and can often be removed once he builds enough equity. Negotiation is a critical skill during this phase. His agent will help him craft an offer that is attractive to the seller while protecting Jimmy's interests. This might involve negotiating on price, asking for seller concessions for closing costs, or including specific contingencies like a home inspection. Once an offer is accepted, the real work begins. Inspections, appraisals, and navigating the escrow process. This can be stressful, with many moving parts and potential roadblocks. This is where his financial discipline and emotional resilience, built over the past 7 years, will truly be tested. During years 8 and 9, Jimmy might encounter challenges. Perhaps the market shifts, interest rates rise, or he loses out on a few offers. This is where perseverance comes into play. He needs to stay focused on his goal, adjust his strategy if necessary, maybe consider a slightly smaller house or a different neighborhood, and not get discouraged by temporary setbacks. His emergency fund will provide a buffer against unexpected costs during the buying process, and his strong financial habits will ensure he doesn't overextend himself. By the time Jimmy is 34 years old, in year 10 of his journey, he is ready to close. The final walkthrough, signing countless documents, and finally receiving the keys. That moment, walking into his own home, is the culmination of a decade of hard work, discipline, and smart financial decisions. He started with $2,000 and a mountain of debt, and now he owns a piece of the American dream. This journey wasn't about luck. It was about a clear plan, unwavering commitment, and understanding that homeownership is a marathon, not a sprint. It required sacrifices, but not deprivation. It required smart choices, not magic. So if you're 24, looking at your bank account, and feeling overwhelmed by the idea of buying a house in the US, remember Jimmy. Remember his journey. Your path might be different, your numbers might vary, but the principles remain the same. Start small, stay consistent, educate yourself, and never give up on your dream. If this roadmap has inspired you, hit that like button, share this video with someone who needs it, and subscribe for more actionable strategies to build your wealth. Your future self will thank you. See you in the next one.